Welcome to vTalkInsight, Risk Sentiment Daily for April 13th, 2026. After one of the strongest equity weeks in months, markets now sit at a crossroads, with an AI-led rally running straight into an energy and inflation shock, plus a new layer of AI-driven cyber risk for global banks. Let us unpack how those forces are shaping today's balance between risk-taking and capital preservation. Risk sentiment today is best described as balanced with a clear downside skew. Equities have just delivered a strong run, with the S&P 500 posting its best weekly gain in months and volatility drifting back toward the high teens. Yet the latest session shows prices essentially pausing rather than extending higher. That combination suggests investors are still willing to hold risk, but are becoming more selective as macro and geopolitical risks accumulate. Earlier in the week, a sharp pullback in crude prices and a rally in bonds helped fuel a relief move across equities, credit, and even crypto, reinforcing the risk-on bias highlighted in recent sessions. Since then, however, the narrative has become more complicated. Physical oil disruptions from the Middle East remain severe, inflation data are re-accelerating on the back of gasoline, and central banks are perceived as firmly in higher-for-longer mode. At the same time, an urgent regulatory focus on AI-driven cyber vulnerabilities is adding a new tail risk, especially for large financial institutions. Counterbalancing these concerns, powerful structural supports remain in place. AI infrastructure and semiconductor earnings are beating expectations. Mega-cap technology and data center names are delivering outsized gains. Bank trading and deal franchises look robust heading into earnings, and U.S. high-yield credit spreads are at or near record tights. The result is a two-way tape. Flows into equities and credit are still supportive, but the market is increasingly headline-driven, with growing use of hedges and a low-volatility backdrop that could change quickly if one of the big macro or cyber risks crystallizes. The first major bearish driver is the Middle East energy shock and geopolitics. Despite a ceasefire, the Strait of Hormuz remains largely blocked, with only a fraction of normal tanker traffic getting through and more than 800 ships effectively stranded. Attacks on Saudi infrastructure, including the East-West pipeline and key export terminals, have damaged assets handling around 700,000 barrels per day and forced output cuts of over 500,000 barrels, removing an estimated 1.3 million barrels per day from global supply. These disruptions have pushed physical oil prices well above listed futures, underlining a disconnect between paper markets and barrels that can actually be delivered. Crude is trading near triple digits, and scenario work suggests that if the Strait of Hormuz stays effectively closed and military intervention remains limited, prices could spike toward $150 to $160 per barrel. Such an outcome would raise the risk of a global recession, especially as Iran seeks formal sovereignty over the strait and Gulf states see little chance of Tehran voluntarily surrendering that leverage. The macro implications are broad. Persistently tight energy supply feeds directly into headline inflation, compresses real incomes, and complicates central bank choices, while also discouraging long-term foreign investment into the region. Equity markets have so far remained resilient, helped by a recent 13% pullback in crude and the view that $80 to $100 oil is still consistent with U.S. growth. But the ongoing physical bottlenecks mean an energy risk premium is likely to remain embedded in both commodities and related equities. For now, the key watch points are any breakthrough in U.S.-Iran talks, signs of a durable reopening of Hormuz, or, conversely, fresh attacks on pipelines and ports that could force markets to rapidly reprice energy-sensitive assets. The second bearish driver is re-accelerating inflation and higher-for-longer rates. March U.S. headline CPI rose 0.9% month-on-month and jumped to 3.3% year-on-year, up sharply from 2.4% in February. Almost all of that move came from a more than 21% surge in gasoline prices linked to the Middle East supply shock, with forecasters now expecting headline inflation to climb toward the 3.4 to 4% range in coming months. Core inflation is more benign on the surface, with core CPI up just 0.2% month-on-month, but stickier components such as rent and owner's equivalent rent are showing little sign of relief. Against that backdrop, The Federal Reserve is seen making very limited progress toward its 2% target, and markets have scaled back expectations to roughly one rate cut this year, with the implied probability of even that move now low. The yield curve has flattened as rates move higher across maturities, and Fed minutes revealing some discussion of potential hikes have added to the perception that policy could stay restrictive for longer than risk assets had been pricing. Consumers are already feeling the strain, with U.S. sentiment dropping to its weakest level since the late 1970s, driven by frustration over persistent price increases and higher gasoline costs. Higher fuel prices are expected to constrain discretionary spending, potentially nudging the economy toward a slower growth or even stagflationary regime. There is a counter-scenario in which a durable Middle East resolution pushes energy prices lower, headline inflation drops below the Fed's target, and policy rates can drift toward a 3% neutral level over time, but for now that remains an upside case. Until the next rounds of inflation data clarify the picture, the higher-for-longer narrative is likely to keep valuation multiples under scrutiny and sustain hedging demand across both equity and rates markets. The third key bearish driver is AI-driven systemic cyber risk to finance. U.S. Treasury and Federal Reserve officials have urgently summoned major bank CEOs to discuss Anthropic's new AI model, Mythos, amid concern that it can autonomously identify and exploit software vulnerabilities across all major operating systems and browsers. Reports suggest the model has already uncovered a 27-year-old zero-day flaw in OpenBSD, highlighting just how quickly frontier AI can surface weaknesses that have gone undetected for decades. The challenge is that a large share of exploited vulnerabilities sit in legacy IT systems that are difficult or impossible to patch, especially at big financial institutions. At the same time, AI-driven code generation is now responsible for a very high proportion of new software in some smaller and mid-sized firms, expanding the attack surface, just as the time from vulnerability discovery to exploitation has shrunk from months to minutes. Authorities are signaling that formal regulations or best practices around banks' use of advanced AI tools are likely, reflecting concerns that existing supervisory frameworks are not sufficient. Markets are beginning to price these risks. Cybersecurity stocks are under pressure on fears that current defenses could be overwhelmed, while corporate adoption of AI tools is facing new headwinds after incidents, such as accidental exposure of large fleets of connected devices. For systemically important banks, the focus is shifting from traditional credit and market risk toward operational resilience, data integrity, and the cost of accelerated security upgrades. How banks frame these issues in upcoming earnings calls, and whether regulators move quickly toward binding standards, will shape whether this remains a contained operational challenge or evolves into a broader risk premium on financials and selected technology names. On the bullish side, AI infrastructure and semiconductor earnings strength remain a powerful counterweight to the macro risks. TSMC has just reported a 35% year-on-year revenue surge, comfortably beating expectations and even outpacing growth at major customers such as NVIDIA and Apple. That performance underscores how resilient global AI chip demand has been, despite ongoing Middle East tensions and higher energy costs. The strength is not limited to one name. Semiconductor stocks and dedicated chip exchange-traded funds are outperforming, supported by accelerating orders for optical components from U.S. hyperscalers, with some suppliers indicating their books are effectively filled through 2028. Data center and digital infrastructure plays are also benefiting. Equinix is up more than 30% year-to-date, and Blackstone is looking to raise around $2 billion for a listed digital infrastructure trust focused on AI data centers. Together with gains of over 5% in the so-called Magnificent Seven over the last 2 weeks, this points to a durable AI-led leadership that continues to underpin equity indices, even as other sectors lag. The next supportive driver is major bank earnings resilience and deal flow. Large U.S. and global banks are expected to show clear outperformance versus smaller and regional peers, thanks to their scale, diversification, and more stable returns. Trading revenues are projected to be up roughly 15 to 20% year-on-year, with recent market volatility providing a strong backdrop for both rates and credit businesses. Investment banking divisions are also poised to benefit from a resurgence in global mergers and acquisitions and a robust pipeline of initial public offerings, with first-quarter M&A volumes at record levels. Commercial lending remains solid, and consumer credit metrics are described as healthy despite broader macro uncertainty. While private credit funds in the wealth channel are experiencing sizable redemptions and alternative asset managers have seen their shares fall 30 to 40% year-to-date, banks appear well insulated thanks to senior positioning and over-collateralization on their exposures. Upcoming earnings from institutions such as Goldman Sachs, JP Morgan, Citi, and Wells Fargo will therefore be a key barometer for how much support the financial sector can continue to provide to the broader risk-on narrative. The third bullish driver is tight credit spreads and robust risk appetite. U.S. high-yield bond spreads have tightened since the onset of Middle East tensions, with the Bloomberg High-Yield Dollar Index reaching record highs. That price action signals strong confidence in U.S. economic resilience, even as oil prices, inflation risks, and geopolitical uncertainty remain elevated. Direct lending volumes are running well above seasonal norms, and institutional investors such as pension funds are increasing allocations to private credit and real assets as part of broader diversification strategies. This comes on top of robust demand for public fixed income, where attractive all-in yields coexist with relatively tight spreads. The flip side is that valuations across many risk assets now embed a lot of good news, from growth to default expectations, leaving spreads and equity multiples more vulnerable to negative surprises, whether from an energy shock, an upside inflation surprise, or an AI-driven cyber event. Monitoring the behavior of high-yield spreads and flows around upcoming data releases and geopolitical headlines will be crucial for gauging whether today's confidence remains justified or starts to unwind. Pulling this together, risk sentiment is finally balanced with a clear downside tilt. A persistent Middle East energy shock, energy-driven inflation, and emerging AI cyber risks are building meaningful tail risks, even as AI infrastructure earnings, resilient banks, and tight credit spreads continue to support risk assets. The near-term path is likely to be driven by catalysts, progress or setbacks in Gulf negotiations, the next inflation prints, and what we hear from major banks and tech leaders on earnings, particularly around CAPEX, cybersecurity, and credit conditions. Watching how credit spreads, volatility, and sector leadership respond to those signals may offer the clearest read on whether the current equilibrium holds or gives way to a more decisive move in either direction. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.